Hey, I'm Gene Goldman. Here's a look at the week ahead for the week of May 8th. Just a heads up, I am traveling this week, so I'm recording this from the road. Last week, stocks were lower, partially on concerns about regional bank issues, partially around the Fed. As a reminder, the Fed raised rates by 1/4% last week, and this was expected. But markets sold off on something that we warned you about last week, that Jay Powell, the head of the Fed, will likely need to talk down the markets, and this is likely going to increase overall market angst. As a reminder, the Fed has said that by year end, the Fed funds rate, and this is their main interest rate, will be at 5 1/8. But you see here, the markets expect the same rate to be at 4.4% at year end. There's a big disconnect because the market basically says, Fed, you are going to cut rates by 0.75% by year end. Someone has to be wrong, and with inflation still pretty high, probably the markets. It's clear the economy is slowing down, and usually when the economy slows, the Fed cuts interest rates when they start to smell a recession. Today, inflation is still too high for the Fed to cut interest rates. So talking about inflation, that's what we'll be watching this week. On Wednesday, we get the Consumer Price Index report, CPI. The consensus expects headline CPI to be at 5% for April, which it was the same as it was for March. If you look at core CPI, that's where you take out volatile food and energy prices, it's expected to decline a little bit from 5.6% to 5.4%. We at Cetera, we think CPI will be even lower than expected for three reasons. Number one, natural gas continues its year-long plunge, as you see here. This clearly benefits heating costs. Number two, food prices also continue to drop. This is great and yummy news. And number three, we do expect used car prices, while they are still elevated, as you see here, they will also continue their decline. The key takeaway is that if lower than expected inflation pans out, this could give the Fed some comfort to cut rates later this year, especially if signs of an impending recession continue to emerge. Thank you for listening. For more information, please follow us on Twitter at CeteraIM, and I'll see you next week back at home. And thank you.